Good morning, everyone. It's a pleasure for me to be here speaking to you today. So I'm Peter. This is joint work with Mathieu Fournier, who's a PhD student of mine at the University of Toronto, and Chris Jacobs, who is a former colleague of mine at McGill and who's now at the University of Houston. So let me start by motivating this. There's actually sort of quite a few different motivations I could give, but let me give you this one. I teach options in our MBA program in the second year. And so, the students have learned about the CAPM model in their first year, and then they show up in the second year. I teach them options. We talk about the Black-Scholes model, and I show them the stochastic process for a stock price in the Black-Scholes model. And there's always a very smart student who will raise their hand and say, "Professor, what happened to CAPM? Why is there no factor structure on the stock price process in the Black-Scholes model?" And, I'll sort of say, well, it doesn't really matter. All that matters is sort of the process for the underlying, and we can ignore that. But, after having gotten that question in a few years in a row, I decided, that it's actually kind of an interesting thing to think about. What would happen if we built in a factor structure into the underlying price process in an option pricing model? What would the option prices look like? So that's really what we're trying to do in this paper. And of course, a lot of water has gone under the bridge since Black-Scholes, and so we know that volatility in the underlying asset is time varying, and it's crucial that we model that in the option pricing model. So building a factor structure into the option pricing models really should not start with the Black-Scholes model, perhaps, but start with something like a Heston model where. Did I lose the microphone? Where volatility is stochastic. So that's what we're gonna do. We're gonna start with a stochastic volatility model and build factor structure into that. Not start with the Black-Scholes model. Are we switching now? Okay. Is that good? Should I keep going? Okay. So there's a literature that started, I think, about sort of 7 or 8 years ago in the academics where. More and more evidence is coming out that there's information in option prices that we can use to look at equity risk quite broadly. So there's evidence that a stock's beta with the VIX, for example, is a determinant of its expected returns. There's evidence that a stock's beta with the skewness of index options is determining partly of its expected returns. And there's papers that show that we can use option prices to back out betas of the stock. So I don't have the references here, but you can see those in the paper. So there's sort of a growing literature looking at. Oh, thank you very much. Looking more seriously at the interaction between. Should we turn that off? Or should we go away from that? I like to walk around, so I asked David for this. Maybe if I go away from that microphone, it'll be better. Or it could be worse, who knows. A lot of interesting work going on, sort of looking at equity options and the underlying equities at the same time in a market-wide fashion, right? So not just look at one stock and the options on that stock, which is the traditional sort of Black-Scholes view, but instead look at the entire market and look for factor structure in equity options. I think we're good to go now. So it's going to turn out that, remember I said before that we're not going to start from a Black-Scholes model. We're going to start from a Heston model where volatility is stochastic. It's actually going to turn out that, wonderfully, that the fact that volatility is stochastic in the model is going to help us estimate and identify the beta of the stock. So that's just kind of a really wonderful, lucky thing that happens in this setup that I'll show you in a bit. So we think that this is relevant not only for academics who are just trying to figure out what's going on in prices, but also for practitioners. So think about in banks where typically the index options might be managed by one desk, and the index option book might be managed by one desk, and the equity options might be managed at a different place. If you have a model like ours that links the equity to the index, then we can actually manage the risks across equities and the index products and aggregate it up. So manage, for example, the total market vega, right? So think about this. If a stock in our model is related to the market, then the option price of a stock is going to be dependent on the market variance, right? So there's going to be a market vega, for example, of each equity option. which is something that you can then use to manage your total market vega exposure in your equity option book as well as in your index product book. And in trading strategies where you're putting together trades across index options and equity options, it's really only in a model where those two are linked that you can say something about expected returns and expected risk, right? If you kind of need a model that has both the equity option and the index option in there to say something sensible about the overall portfolio risk. So we think there are some interesting practical applications of this model as well. There's a bunch of related academic papers. I will skip those here, although you will hear from this gentleman later on. So there's lots of work that Dilip has done that's related to this. This is just one of those papers. So here's the overview of what I'm going to talk about today. So I'm going to start by showing you just what the data looks like. So I'm going to take 30 stocks, and we're going to look at the equity options on those to see, is there factor structure? If so, how? Right? Is there any kind of factor structure going on? We know that if we just look at the underlying stock returns, there would be a factor structure evident. But how is that factor structure evident in equity option prices? It's not so obvious. And we're going to look at equity option implied volatilities, not dollar prices, and see if there is a factor structure going on there. So it's not going to be totally trivial a priori that there is a factor structure, but we're going to see that there is indeed a very strong one. And that's, of course, why I'm showing you this stuff. Then we're going to go and with these empirical findings in mind, we're going to go specify a theoretical model that has sort of a Heston-style model for the market, and then another Heston-style model on top of that for the idiosyncratic variation in the firm. So, of course, even if there is a factor structure, there's also has to be firm-specific variation in the model, and so we're going to have a two-factor model that captures that. And both of those factors are going to have stochastic volatility. I'm going to show you some properties of the model, and I'm going to fit the model to the data and show you how it fits these 30 options as well as the index. So that's sort of what we're going. Yeah, please.
What's your preference to work with hidden or observed factors?
Yeah, so this is a very first stab at this. So there's just going to be one factor in the model, and it's just going to be the market, and it's going to be very simple. But the data that I'm going to look at first, before we look at the model, may suggest to you that there's more going on, and we can think about other theoretical models that would be consistent with the data. So have a look at the data, and then we can talk about that later. The model is the factor model that we have is going to be very simple. We think there's more than one factor for sure, but we start with one, right? We just got to start somewhere, and yeah. There's certainly other ways to do the theoretical model, but nevertheless, I think you'll find the data interesting. So here's the data. So I'm going to take my index, my market factor, to be just the S&P 500, because we have a wonderfully rich, market for options on that index. So that's going to be my market index. So that's the observed index, to answer your question right there. In our work, we're going to think of that as the observed index. So the index is observed in our model, as you'll see. Then I'm just going to take. We just had to pick a number of stocks that we could manage to work with, and that was somehow representative, and that have options on them. So we chose the Dow Jones 30 on a particular date. We chose just the 30 stocks in that, and then we threw out Kraft for some data reason, so we end up with 29 stocks. So we're going to have the index and 29. So we threw out Kraft. The data sample is when option metrics start until 2010, which was the data available when we started working on this. From option metrics, now there's more available. And we do some standard filters to throw out quotes that we think might be not so liquid and not so trustworthy. So those are sort of just a standard preliminary filter of the data. There's lots of really tiny numbers on this slide, and I'm not going to talk any detail about it. Just to highlight for you a fact, and a fact that you already know, is that the market for index options is much, much more liquid and sort of deep and wide than the market for any individual equity option, even for these large stocks, right? So index options we have lots more information in terms of number of contracts and so on for index options, hundreds of thousands, than we have for equity options, where we have on average, let's say something like 40,000 calls and puts in the sample. So remember 96 to 2010. And the average implied volatility, not surprisingly, is higher on average for firms, about 30% per year, than for the index, about 20% per year for the sample. Not surprising either. This table is also just so you can see the stocks. If you're sitting close to the front, otherwise you can't see them, but you can kind of guess what they are. Don't think there's anything we need to talk about there. So the first thing we did, we just said, let's just plot. You can see this is plotted over time, right, from 1960 to 2010 in our sample. Let's just take 6 of our 29 stocks, and let's just plot the 1 month at the money implied volatility from the equity options on that stock. And I'm just going to pick 6 of my 29s. You can see Boeing, Coca-Cola, Home Depot, Merck, Procter & Gamble, and Walmart. And the black line in each graph is the 1 month implied volatility of that stock. And the gray line in each panel is the 1 month implied volatility at the money from the index options. Right? So the gray line is the same in all 6. And the black is then the firm-specific one, corresponding to the firm that you see in the heading of the table. So you can see that, just sort of eyeballing this, that it looks like, indeed, there is a lot of commonality in the level of implied volatility. Of course, because we're using new options every day to imply out the volatility here, these things change day by day, both for the index and for the stock. You can see a lot of sort of common variation, right? In the bull market of the early 2000s, volatility is extremely low, and there are other times in the financial crisis, of course, most obviously, but also in the sort of the dot-com bubble and burst, and in the very early 2000s, where volatility was high sort of everywhere. So just sort of eyeballing 6 stocks and comparing those short-term implied volatilities with the market, it looks like, indeed, there's a lot of commonality in option implied volatility. Right? This is, of course, just the first.
You know, if the stock-specific VIX has been constructed and you have access?
Stock-specific?
VIX.
So this is our VIX, right?
Yeah.
This is my own personal VIX for each stock.
Right? You can build the VIX from the option quotes from the
Yeah.
individuals.
Yeah, so this is just the old school VIX, just simple averaging of the ones around 30 days, and it runs around at the money. But this is indeed, yeah. So this is homemade VIX for each company against the actual VIX in gray. You can think of it that way. So we're encouraged by this to plow ahead, right? To look for factor structure. So the way we're going to look deeper into the data is by doing a principal component analysis, right? So we're going to think about the data, right? It's 29 stocks. For each stock, we have options, we have different maturities, different moneyness, and we observe it over time, right? So to get a handle on all this data, what we do is for each company J, we run a regression where the left-hand side is implied volatility for company J on day T for contract L. So contract L is particular maturity, particular moneyness for that option, right? Regress, so this is a firm implied volatility on a particular option on a particular day. We regress that on moneyness and on time to maturity, days to maturity, where these have been standardized to have mean 0 and standard deviation 1, which is not so clear from the notation here, but they have. So that you can think of the constant term here as the level of IV, right? Because the regressors have 0 mean. And so now what we're going to get, because we're going to run this regression on every week, we're going to get a coefficient every week that gives us the constant IV for the firm, the moneyness slope for the firm, and the maturity slope for the firm. And then I'm going to do analysis on these coefficients here. So now, right, I'm going to have 29 firms. So I'm going to have 29 constant terms that I observe over time because I run the regression every week, 29 moneyness slopes and 29 maturity slopes. I'm going to have a matrix of each of these guys because I have time and company variation in the constant moneyness slope and maturity slope, right? Yeah. What's that? Yeah, that's a good question. We should put in some nonlinear terms. This will get us something. We might be able to get even more if we had nonlinear terms. We know that the linear is actually pretty good for index, but for firms, it's not so obvious in that sometimes it may actually be a smile rather than a smirk, and so we may indeed need a square term. So yeah, I would put a square term on moneyness for sure to see how that would show up. For now, it was just kind of easier to have one number that we can call slope, but I'm actually very sympathetic to that we should put in probably a square term for moneyness. Everything else, I think we could live with, but a square term for that would be good. So it's on our to-do list. So we have three matrices now, right? So now I'm going to do principal component analysis on each of these three matrices to see, is there a factor structure in the level of equity option IV? Is there a factor structure in the moneyness slope of IV? And is there a factor structure in the maturity slope of the equity options? So that's really what, that's going to be my tool for looking for factor structure in equity options. Right? So it's not just the level that we just looked at in this picture that will be captured in the A, right? But it's also, is there factor structure in this moneyness slope and the maturity slope? So we're actually going to use optiometrics volatility surfaces here, not the filter data that I just talked about. That we're going to use that for estimation. But for this, you have a sort of end up with days with missing data if you don't use the volatility surfaces. So that's what we're going to do. So first of all, now just start with level. So my A coefficient here, right? So level of IV. So what I'm showing you in this picture up here is just the A coefficient if I ran this regression on index options. Right? So think of that, again, you can think of that as sort of a blue-collar VIX. Right? It's something that tells me something about the level of option implied volatility from the index options. In the bottom panel, I'm showing you, so this you've seen before, and it looks just like VIX, right? Where we have these units here in annualized standard deviations, right? So on average, something like 20%, and peaks up in the crisis. What I'm showing you down here now is the first principal component from my principal component analysis on the matrix of A's. So right, A's is over time and across firms, so I end up with the matrix, go to principal components, and here it is. So when I do all this regression stuff, do principal component on the constant term, I end up with, and show you the first principal component, I end up with this picture here. So the first, to my eyes, of course, but I'm slightly biased, to my eyes, of course, it looks like you may not be able to tell if I had switched the pictures, right? You may actually not be able to tell which is which. There's a very close commonality between the index option implied volatility and the first principal component of the equity implied volatilities, constant term in the regression. So you can see here, these are just for the 29 firms, the loadings on the first component. You can see they're all positive. That's really all I want you to get away from that, from this here. So all the 29 firms have a positive loading on the first principal component. More importantly, what I want to show you that so these are just the average of the components. So here is how much of the variation have we captured by the first principal component. It's 77%. The second component captures 13, the third 2%. So the explanation that the components explain dies off very quickly as I increase up to, I could have, of course, 29 components, right? I have 29 firms. So very high. The first component explains a lot of all the variation in the A's across firms, and the first component has a 92% correlation with the market. So this thing that shows up in the picture here, the fact that these two look so closely related is indeed not just some picture magic. If you do the correlation, it is 92%. So the levels are very highly correlated between the market implied volatility and the first principal component from the level from the constant term in my regressions. The second thing we do then is look at the B's. Remember the slope of the moneyness. So the level is maybe trivial, and you can say, yeah, I probably knew this already. Maybe you did, that's fine. So now, this I don't think you've looked at before. So this is now the principal component analysis on this moneyness slopes for each firm, right? So here is, if I just run my regression on the index options, I get the moneyness slope with the critique that maybe we should have a nonlinear term in there as well, which I'm actually quite open to exploring further. So this is a moneyness slope in index options. This is the first principal component of the moneyness slope in the 29 equity options, right? So you can see here clearly the relationship is not as close as it was for the level, maybe not surprisingly, maybe because we missed the square term, or maybe because there's just a lot of firm-specific variation in moneyness slope that is not there in the levels. Anyways, if you look at the loadings on the first principal component, again, they're actually all positive, so that's kind of interesting. And they capture The first principal component captures 77% of the variation across firms, and the second is only 5. So actually very strong factor structure in the moneyness slope, and quite a high correlation between the first principal component of the equities and the market slope. Right? So not only does it look like there's very much look like there is a factor structure in the moneyness slope, it is driven by the market at least to market slope at least to a large extent. Please.
Is the moneyness slope in the money as well as out of the money? Or could you just filter it out of the monies?
Yeah, for this, we used everything. I think it's just because we sort of, as large as these firms are, sometimes you just run out of data if you don't use all of it. So we actually use both in and out of the money for these regressions. In the academic literature, so it's sort of common to only rely on out-of-the-money stuff because we think it's more liquid and so on. But for this, I think just to make sure that we wouldn't end up with a bunch of days with missing data, we actually used all of it. These numbers don't really change. I just end up losing some days if I use only out of the money. Yeah, so that's not driving the results. The fact that I have in the money in there is not driving the results. It's a value-weighted index. So I'm not using the Dow index at all, right? I'm just choosing stocks from the Dow.
I'm wondering whether that massive component of index is coming from the 29 days.
Sure. It may not be surprising. It may not be surprising that the level of volatility there's a strong factor structure. But it's not so obvious, I think, to me, that why would the moneyness slope be so have a common component and it's correlated with the S&P 500. Or I mean, to me, it's just basically saying that, look, if you write down a model, an option pricing model for equity options that has a factor structure, it needs to have these features. Really. I'm not saying that, yeah, maybe you're surprised, maybe you're not surprised, that's okay. But if you build a model, it has to have these properties, in my view, to fit the data, right? So think about if we just build a Black-Scholes factor model, it wouldn't have any of this, right? Because the IV would just be constant across maturity and moneyness and everything, right? So it's not a trivial matter to actually build a model that has these features. Remember, it's IVs I'm running it on, right? Please, Professor.
There's a literature on option pricing that says, look, when you have vol skew, obviously you don't have log value. And they do an expansion around the logarithm, like Harvard and they get a model that, has kind of Black-Scholes component, but implied vol and has an implied skewness component and implied kurtosis component.
Yeah.
Now, it applies for individual equities, and it applies for the market as a whole. So in a sense, and at every point in time, so in a sense, you look at the changes in each one of those, and there are natural factors, and if you look at it for the market index, and each one of those have a correlation with the market index.
Yeah, that would be interesting. So these are static models?
Yeah, they're static models based on a terminal.
What allow for non-normality? Yeah, no, that would be another way to get at it, which is a little bit more parametric than this, but
It allows for the possibility of nonlinear correlations.
Yeah. No, I think that could be interesting to look at this sort of from through that lens as well. Absolutely. There's a Backus, Ferrazzi, and Wu paper too that tries to do something like that I've seen. So yeah, because it's clear, of course, right, that non-normality is very important here, right, and it's sort of the name of the game. And the fact that we find something here also, suggests that these are IVs. Remember again, so it's not. We're far away from the Black-Scholes world here. So the last thing we look at is, remember, the implied volatility slope. So the top picture here shows the just when we run the regression on index option every week, what is the slope for implied volatility for the index on time to maturity? And then down here we do the same regression for all the 29 firms. Get the coefficients on maturity out, get that matrix over time, and then do the principal component analysis. And I'm plotting you here again the first principal component of the maturity slope for all the 29 firms. And you can see again that there's clearly some variation that's independent between the top and the bottom, but also some fairly strong commonality, including here in the crisis where where the term slope went from being sort of close to 0 to being highly negative, and that happened in both in the index options and the equity options at around at sort of the peak of the crisis, at least the peak of the equity market crisis, at least. Again, for the maturity slope, the coefficients are all positive for the first component, and the first component captures about 60% of the variation across firms, the second 13, the third 5%. So a lot of stuff is explained by just one, right? That's the thing. We didn't know how many factors you really need for this stuff. It turns out one actually does quite a bit on all the three dimensions that we look at: level, moneyness slope, and maturity slope. And there's a high correlation again with the slope of the index. So it looks like one factor is going to do a lot for you, and it looks like that one factor is the market, is the index option. So that's what we've learned so far from just looking at the data. So lots of evidence of factor structure in these IVs, and the first principal components look like they're highly correlated with their counterparts from index options. So that sort of gets you to building. So the first model you may ever think about building, it would be one where we have stochastic volatility in the index and then build a model for the firm around that. So that's what we're going to do. So we're going to simply have a Heston model for the index, and then we're going to try to build on that. And to construct an equity option pricing model, right? Remember, that's what we want to do. Construct an equity option pricing model that has a factor structure. Think about this identification that I alluded to at the beginning. In a simple multivariate Black-Scholes-Merton world, you would not know whether volatility of an equity option is high because the beta is high, because the market volatility is high, or because idiosyncratic firm volatility is high. The equity option volatility could be high for all those reasons. You would not be able to identify beta from just observing equity options and index options, because volatility is constant. In our world where volatility is going to be dynamic, you can think about the firm volatility as being beta squared times the market volatility plus idiosyncratic volatility. If market volatility and idiosyncratic volatility both vary over time, and if beta is constant, then that actually allows you to identify the firm beta from options. So that's in effect what we're going to be doing.
You have a return beta plus a volatility beta, right? Because there could be a beta in the relationship.
So we don't really have that. I'll show you what it looks like. Ours is very simple because we want to get closed forms and so on for the options. Yeah, please.
In the Black-Scholes world, the index is a sum of the individual option equities. So then you've got you're comparing the implied vols on the individual equity options to the implied vol in a basket. So it's like it'll come from you. It's going to be non-log normal, so it's a sum of log normals, and it's going to have a skew and get a structure from the underlying equity functions.
So you're saying you might be able to identify beta in such a world from options, from equity options and index options?
I mean, given the underlying processes, you automatically know where the options have to price on
yeah, the beta is not just the beta.
Correlate.
The beta is not just the weight, though, right? The beta is not just the market weight at all. So it's not so obvious. And yeah, I have to admit, though, we haven't actually tried to identify beta from a pure Black-Scholes-Merton model. I don't think it's possible to do it empirically. I think you need time-varying volatility to ever have any hope of identifying the betas from options, and that's what we do. But I'm not actually going to show you that it's impossible. I think it is impossible to do it, at least empirically, even if maybe theoretically you can, although I'm skeptical about that too. But maybe you're right. But we're going to have stochastic volatility everywhere. So here we go. So the good old Heston model, maybe just with a slightly different notation than what you're going to look at, than what you're used to. So I is going to be the index. This is going to be the S&P 500. So the instantaneous return on the market is going to be the risk-free rate plus a risk premium plus a stochastic volatility multiplied by a Brownian innovation. The stochastic variance is Cox, Ingersoll, Ross, right? So we have mean reversion kappa for the variance of the index, long run theta variance for the index, and volatility parameter delta I. So square root, kind of a process for stochastic variance of the index, which means that we know how to construct option prices for the for the index options, right? This would just be Heston's formula right away for pricing options on index options. Now, so what we're going to do is we're going to build a model for the equity around this index model, right? So here's what we're going to do. The simplest thing you could think of doing, and there may indeed be much better ways to do it. This is what we've done so far. So the stock J, remember this is the equity J. The instantaneous return on the stock J in excess of the risk-free rate is going to potentially have some alpha in the physical world, plus the key thing here, beta, right? So the beta of firm J is going to be the loading on my market index, instantaneous excess return on my market index, plus an idiosyncratic firm volatility for firm J. So this is just the idiosyncratic. So remember, the index has its own volatility that's stochastic. So this is just the additional idiosyncratic volatility for the stock. The idiosyncratic volatility is going to have its own Heston dynamic. So the idiosyncratic variance, sigma j, is going to have its own kappa j, its own theta j, and its own delta j. So you can have idiosyncratic stochastic variance that's mean reverting around theta with the vol-of-vol theta j. So notice that, again, that the total variance for the firm, I'm going to call that V. The total variance for firm J is actually beta squared market variance, I hope you can see it on here, plus theta squared j, the idiosyncratic variance. So two components in firm variance, market variance plus idiosyncratic variance.
All your value motions are uncorrelated?
No, they're correlated. So there's the usual correlation. So there's the leverage correlation. I thank you for bringing that up. I didn't say that. These two are correlated with some, I guess we're going to call it rho capital I. And then these two are going to be correlated with rho j. But the other correlations are zero. The last correlation is zero. So there's a leverage effect in the market variance. There's a leverage effect in the idiosyncratic. And that's it. Thanks for bringing that up. So a Heston around a Heston, right? Basically, with a constant beta on it. Putting all this structure on it means that we can solve for the equity option price in closed form to the extent that Heston is closed form, namely that you have to solve an integral numerically, right? You have the closed form characteristic function. Conditional characteristic function is in closed form, so you can do Fourier inversion to solve for the price using numerical integration. We also in the model talk a little bit about risk premium. So we're going to have the equity risk premium that I talked about, mu I. We're going to have a variance risk premium, which is something that the academic literature is talking a lot about these days. We call that lambda I. There's not going to be a variance. So there's a variance risk premium on the market variance, but not on the idiosyncratic variance. So we think of that as sort of being something that can be diversified away. So why have a premium on that? Whereas variance the market variance risk premium cannot be diversified away, so that makes sense that that carries a premium. So when you sell index options, you earn that lambda I. And of course, there's the equity premium, there's the potential alphas, and the key thing we're interested in is in the beta. So the risk neutral process is going to look just like the physical process, except the mu is going to be gone. My lambda is now going to show up, but I'm built into the mean reversion and the unconditional average, the unconditional variances. The key thing I just want you to take away from this is that in our model, beta is the same under the two measures. So the risk neutral beta is the same as the physical world beta, which means that if you estimate beta on options in our model, that would also be the beta in the physical world. So it would be the beta that you in principle could use for whatever you use betas for, cost of capital and so on.
Can you just comment sort of a naive question here? When you talk about beta that relates, the equity option IV to the index IV, is that beta different from the one that relates to the equity return to the index return?
No, thanks for bringing it up. No, it is the same. In our model, it's the same. In the best of all models, they may not be the same. But in our simplest of all models, with just the stochastic volatility added, you can see from this equation that the instantaneous return on the stock is beta times the instantaneous return on the market. So it's just like what we're used to seeing.
So from a trader's perspective, why would one go about this approach as just simply reversing returns, which would be much easier?
Because we know that those estimates are terrible, is one answer. We know that it's very difficult to estimate beta reliably from individual stock returns. So So indeed, one motivation for this paper is we want to get better beta estimates. I haven't sold it like that really, but that is actually one motivation. And so this provides a framework in which you can estimate firm betas from options. There's no doubt it's a lot of work. It's a lot more work than running regressions for sure, but we're using a lot more information.
But from a trading desk perspective, let's just simply say, I'm managing a portfolio of equities, and I'm beta hedging. And so what you're saying is the betas that one would back out from this option implied beta is better or more stable than the beta that you got from the regressing the returns of an individual equity against the index. Have you done any sort of out-of-sample testing to verify that the variance from your option implied beta is better than the equity implied beta?
Not the kind that you would probably like, but I'm going to show you a scatter plot at the very end that gets a little bit to that, where we estimate the betas the way you say with regressions and compare them to what we get out from estimating our model. You may not say that mine look better than the other ones, but they are different, and I'll show you how they're different. And I think so we haven't done this exercise that an academic would do, would say, okay, do the betas I estimate help you price equities in the cross-section better than your regression betas, for example, right? That's sort of the ultimate academic test of beta estimates. And for that, though, you need, 700 stocks, not 29. And so we don't quite have the computer power to do that yet. But ultimately, that's what we would like to do. Do it for many stocks, to all the ones that we can that have options on them, and see whether the beta estimates are better. So that is actually one motivation. So I'm happy that you brought it up. I haven't sold it that way yet, but really, when we first started on this, that was one of the motivations. Remember, I said in the beginning there were many motivations. That was one. So yes, this is a way to estimate betas using options, right? So I think I said this before. Because of all the structures we put on the model, it's essentially a two-factor Heston model. We can use the tools in Heston to price options in quasi-closed form. You have to do a numerical integral, but you don't have to do Monte Carlo to price. So we provide the conditional characteristic function in the paper, and I don't have a slide of it here, but you can see, you can find that in the paper. So that was the model. I'm going to show you what the model implies. If you just sort of put in parameters into the model and draw some pictures of implied volatilities from model prices, what do they look like? Okay, so the total variance in the firm is beta squared times market variance plus idiosyncratic variance. So everything else equal, the bigger the beta is, the bigger is the variance for the firm, right? Not surprising. So let me just show you a picture here instead of the equation. So in this picture, I have moneyness, S over K. Remember, we used that in the PCA regressions in the beginning. Moneyness is on the x-axis, and on the y-axis is implied volatility. What I've done is I've just put in a bunch of different sort of typical parameters into the model, and then I've constructed model option prices, taken implied volatility, implied Black-Scholes volatility of the model prices, and then I'm showing you model smiles for different levels of beta. So the lowest line down here has a beta of 0.6, and the highest line up here has a beta of 1.4. I have fixed the physical total variance in the model to be the same across all lines, so that these things are in a sense comparable. So the question is, right, in the model, does beta matter for option prices? Does it matter whether a firm has a beta of 1.2 or 0.8? Does it matter for their option prices? And this picture shows that, yes, it does. With this parameterization that I've shown you here, a 1.2 beta firm would have sort of a steep smirk implied volatility function, whereas beta of 0.8 firm would have an implied volatility function that looks more sort of like a smile, right? So depending on the beta of the firm and, of course, depending on the volatility, spot volatilities and so on, you can generate all kinds of different all kinds of different types of smile in this model. And beta matters. When you change beta and keep total physical volatility constant, implied volatility changes, right? So beta matters for options. And not just sort of in a non-trivial way. So this is a picture here where I put on the x-axis maturity in years, and again on the y-axis I have implied volatility. So and then I have 5 different betas from 0.6 to 1.4, and again I've held physical volatility the same across all 5 lines and just changing beta. And what you see here is that beta matters for the maturity term structure, If you have a very high beta, you're going to mean revert quicker to the unconditional. So you're going to have a steeper maturity term structure than if beta is small. Please.
Quick question on the computation of beta. I presume, as you mentioned, are regressions being done here?
So it turns out actually, what we learned from writing down this model, that if you have a VIX for the market, which we all do, and you compute your own VIX for the company you're looking at, so you have options, 30-day at-the-money options through a couple years period, you can compute your own VIX for that firm, just like I showed in that picture in the beginning. So you have a VIX for the market, thanks to CPOE. You compute your own VIX for the firm that you care about. If you regress your own firm VIX on market VIX, the coefficient on that will be something like beta squared. So that would actually be an incredibly fast way to use option data to estimate beta. We're, of course, academics, and so we're going to do it in a very complicated way, but there is an easy way to do it.
Following through on that, for the most part, regressions of any shape or form have been done since the beginning of the financial engineering investment kind of structured process. But along with
even
that,
longer, probably.
But along with that, it's I've been told in the past that this is not done in the financial world. Is there ever a check to make sure that the regression could be done, that those 5 assumptions are met, so that what you're ending up with is truly beta?
Yeah, no, I mean, of course, anytime you estimate a beta, the estimate you get out is conditional on the model you wrote down in the beginning being something reasonably close to the truth. If it's a misspecified model, the estimates you're going to get out are probably going to be quite meaningless, right? And so I think it's difficult to say anything general to your point other than we're always trying to write down better models, and we're going to get better estimates if the models get better. One of the things that I, of course, as I've sort of been trying to push to you that I particularly like about this is, right, we have the stochastic volatility for the market and for the idiosyncratic firm variance, which I think makes the model look a lot more realistic than a model that would not have those features. And so therefore, I trust my betas more than someone who wrote down a model that did not have these 2 stochastic volatility processes. Because really, to me, sort of the number one thing that we've learned in the last 20 years is that, you know, stochastic volatility is a fact of life, and it's almost everywhere you look in financial markets. It's very strong, at the market level, but also at the firm level. And so I think building those things in makes the model much more realistic and enables us to trust the estimates more better. Now, would I like to write down a much better model? Yes, I would like to have a model where the market has jumps, for example. I haven't been able to do that yet and derive a closed form solution for the equity option price. But I think one of the bright young minds here could probably do that, and I think that would make an even better model and would in turn then get you betas out. So you can imagine a beta, like a good old-fashioned beta, and then also a jump beta, for example. I think that will be very neat. So that is one shortcoming that our model has now. What I like about this, right, even if we're running regressions, I think when we run regression of VIX on, firm VIX on market VIX, we're going to run regression on stuff that has a lot of information compared to, let's say, running a regression on just daily returns or weekly or monthly returns. Those things are incredibly noisy, as we know, right? So when the betas you get out are going to be very noisy as well. So in academic literature, you never see almost any papers that regress of company return on a market. You never see firm betas. You always see people running regressions of portfolio returns on factors. So you get portfolio betas out because those betas from individual stocks are so noisy. Now, what I said is a very broad generalization of the literature, but to a large extent that has been true until recently. Please, Professor. Yeah, so of course, I was waiting for you to say that. But so of course, in our model, beta is constant. We would love to have a time-varying beta in our model, and somebody hopefully will do that. That's not so easy to do. We're looking a little bit at Wishart processes and so on to actually have time-varying correlation and then get a time-varying beta that way. We're starting with this. So in practice, what you would do is maybe take a year of option and estimate beta, keeping it fixed, in sort of that window. But time-varying beta, we would love to have clearly. No doubt. I'm just going to do a time check here. Good. So the model that we've written down is nice because you have closed form prices, but it's also nice in that it delivers Greeks, market Greeks for equity options, right? So the instantaneous change in an option on firm J with respect to the market index value is some function of beta. So I know now how my equity option relates to the market index moving. So it's a delta, but not with the underlying firm price. It's a delta with the market for the equity option, right? And what you may care even more about is the market vega. So it's the derivative of the equity option price with respect to market variance. So when market variance changes, when VIX changes, what happens to my equity options on IBM, right? The model has an implication about that that depends on beta, comes up beta squared. And so now if you have a big book of equity options, right, you're maybe used to just managing the delta of each underlying separately and the vega of each underlying separately. But what this model allows you to do is actually managing the vega across all equity options and managing your overall market vega. You're going to have equity index options that are going to have a vega, and then you're going to have all your equity options that are going to have a vega with the market that can be constructed from the model that we've written down. So I think sort of a nice practical application of this is risk management implications for banks or others that manage large books of equity options and index options at the same time. Our model, of course, also implies an expected return for the options that is the function of beta as well as the risk premium on the market. So you can construct expected returns on IBM options as a function of the beta of the beta of IBM. So estimation, the easiest way, regress company VIX on market VIX. You get beta squared, you take square root, you have beta. Now, if you care about estimating all the parameters in the model, and this is how many there are, there's 4 for the market, including the leverage effect. And then there is 5 for the company, because we have beta in addition to the 4 idiosyncratic volatility parameters. And notice here the leverage effect for the idiosyncratic is rho little j. So we want to estimate all these parameters. We do that in and remember, we also have to estimate on each day a spot variance for the market and a spot variance for the firm. These are latent in the model. These are latent processes that we don't observe, and so we need to estimate these as well. You can filter them, or you can estimate them as separate parameters, which is what we do here. So we have this sort of multiple-step estimation process. We first estimate on each day, we estimate the spot variance for the market by fitting the options on that day. That gives us a spot variance for each of all our days in the sample. Then we use that path of latent variances to fit the structural parameters by minimizing the errors across the whole panel of options. And then we iterate back and forth between these 2 steps until in the end we end up with structural parameters that we're happy with and a path of spot variances that we're happy with. So it's iteration between estimating all the spot variances and the structural parameters, which are these 4 parameters that I showed you before. Then we do the same thing for the equity, keeping the index parameters fixed. So my market index is estimated first, keep all those parameters and spot variance paths fixed. Then I estimate my beta and my idiosyncratic variance parameters in a second round, again iterating between 2 different steps, but having kept all the market parameters fixed. So here are parameters. I don't know if you can see this stuff in the back. You probably can't. So I'm just going to show you that because we don't have jumps in the market model, we get a very high negative rho. Sort of that rho has to pick up skewness, which we would love to have some jumps to pick up. We're also getting very high negative idiosyncratic rhos. I'm trying to figure out why that is. I think it's an artifact of the data. So we're re-estimating the model now on the volatility surfaces instead of the raw data to see if that helps. But other than that, the parameters look quite reasonable. I'm going to show you some measures of fit. We plot, let me just see, I want to show you some pictures rather. Okay, so let me just show you some pictures that I think you can relate to more easily than all these numbers. So here, what I plot for my 29 firms, I can't remember how many I'm going to show you. But say, for example, Alcoa here, moneyness on the y-axis, on the x-axis, implied volatility on the y-axis. The market IV on average through my sample, remember 96 to 2010. So the solid line is what the market is actually telling us, the data. And the dashed line, the dotted line is the model fit. So it's the model fit in IV term in the moneyness dimension when I just simply average over all the years in my sample. And you can see that there's actually quite a bit of variation across firms in what the smiles look like, what the smiles and smirk look like. So firms look quite, maybe not surprising, but some of them look very much like a smirk and others look more like a smile. And the model kind of has to try to fit all that and does so to what I would argue is a reasonable degree of success. Think about how much variation there is across firms and compare the model and fit to the market. I think is not bad. Remember, this is just, of course, on average across the whole sample, but in the moneyness dimension. Right? The thing we fit the worst is the market. Remember, this is this thing of we need something. We need maybe a second volatility factor in the market, or maybe jumps in the market or something like that. So I would love to have a richer model for the market that would probably make my fit of the firms even better. Right? But other than that, I'm quite happy. Here I split the data. So now I have maturity on the x-axis in years, in fractions of a year. So I now split my data up in all the days that have, on average, downward sloping term structure and all the days that have upward sloping term structure. So I split the data up into two. So you see two solid lines in each plot, right? The days with downward sloping term structure and the days with upward sloping. How does the model fit those two subsets of the data, right? That's the dots. So again, you want to see how close the dots are to the solids. But now there's two. I've split the sample into two sets. So, there's definitely some discrepancies, but I'm also zooming in very closely on the data, so you can see on the scales. So in general, the model does a reasonably good job of fitting both the days when the term structure is upward sloping and days when the term structure is downward sloping. And again, maybe we need a better model for the index. The index is where I think that you can probably argue that the deviations between these two sets of lines is the largest. Here, I'm pretty sure that a second volatility factor for the index would actually help a lot. And that I think we can still solve for the equity option price formula if we have a second volatility factor. So then we have three factors in the equity, right? So remember in the beginning, we ran these regressions of implied volatility on just having a constant term, moneyness, and maturity. Oh, we wanted to look at the betas. We completely didn't look at the betas in that table. That's what we all care deeply about. My bad. Let's go back. Let me just show you the betas. So do I have all of them here? So here we start. So beta of the different firms are here. So, and you're going to think that I doctored this, but I didn't. The average beta is 0.99 across the 29 firms. So remember, beta is constant in my model, so we just fixed it through 96 through 2010. So the beta comes out to be very nice on average, and it's almost too good to be true. The lowest is, one of the lowest is 0.77, one of the highest is 1.3, JP Morgan. And so there's quite a bit of variation in beta, but on average they're very close to 1. And so, remember these are only estimated from options, equity options and index options. So that was our betas. Now, what I'm doing here is I'm just simply taking, remember when I ran this on my data before I used any models at all? I'm just going to take my coefficients now. So I'm going to put on the x-axis my beta estimate from the option model. And on the y-axis, I'm going to have my A coefficients from the PCA regressions in the beginning. So you can see there's 29 dots, one for each firm. There's a beta for each firm. There's an A coefficient for each firm. This is the average over time. And you can see that on average, and then I just fit a regression through it. So on average, the higher the beta of the firm, the higher the level of implied volatility, the higher the AJ coefficient is on average. Here again is beta on the x-axis, 29 firms in the picture. Here's my moneyness slope from the PCA regression now on the y-axis. So I scatter plot the beta of the firm estimated from my model against the model-free estimate of the moneyness slope from the PCA in the beginning. And you can see in general, the higher the beta, the higher the moneyness slope. You can see the fit here is not as good again. Maybe as brought up, before is that because really we don't think a linear relationship is the right way to capture the moneyness effect. So maybe we need to build in some nonlinearity here to capture the moneyness slope better in the data. I'm totally open to that. Finally, the term structure slope. So again, beta from the model on the x-axis. On the y-axis, the model-free PCA coefficient for each firm averaged over time. And you see on average, the higher the option implied beta is, the higher the term structure slope. So indeed, it looks like the betas we've estimated from our option pricing model are related to the purely model-free features of the equity option data that we got from the PCA analysis. So there's some suggestion there, indirectly at least, that that the model captures something in the data. Now, regression betas. I'm almost done. I think I just have the conclusion after this. So regression betas, thank you for bringing that up. This is a good plug for this slide. So again, on my x-axis here, I have the option implied beta. You can see there's 29 dots, again, corresponding to each of the firms. On the y-axis, I now have OLS beta. So that's the regression beta. So I simply do daily returns of the firm on daily returns for the market. And I run a regression through my sample period, which is, remember, 96 to 2010. And then I scatter plot my OLS betas on the y-axis against my option implied betas on the x-axis. And you see the scatter. The 45-degree line is the gray line here. And the black line here is a regression line of regressing. Now, so I'm regressing betas on betas, right? I'm regressing OLS betas across the 29 firms on option betas. Was there a question?
Do you have graphs of the error terms for these various computations or regression? Because it kind of looks like the error terms themselves tend to be growing as they move out, and wouldn't that have to be corrected for?
In this picture here?
Heteroscedasticity, right.
In this picture here, remember, we don't know what the truth is. Right? We don't know what the true beta is. All I'm trying to say is that, look, first of all, I'm quite happy that my incredibly involved option implied betas actually bear some resemblance to the simple regression betas. I'm also quite happy that if you look at the range of variation of the option implied betas, it's actually somewhat narrower than the range of variation for the OLS betas. This is this effect that we talked about before, that when you run regressions of returns on returns, you typically get very noisy estimates, and that this range of variation in the betas may indeed be showing us that. Please.
When people do daily betas, they often do like Sholes-Williams.
Yeah. So this is not Sholes-Williams equation. So yeah. So we could, of course, shrink that to 1. We could shrink these to 1. I'm showing you the raw unshrunk betas. Yeah.
No, they're two separate things. One is the non-synchronous trading, which is...
Oh, yeah. Oh, you meant the asynchronicity. The asynchronicity.
And the other is a Bayesian adjustment.
Yeah. Remember, these are the 29 enormous... Yeah, these are 29 huge stocks. So I'm actually... Yeah, so the asynchronicity, maybe we should worry about. But, yeah, we could try to do the Sholes-Williams corrections. I thought you were saying shrink it to 1. But that's, of course, a separate issue. But you may end up effectively doing that. Yeah, so... Again, we don't know what the truth is, but there definitely seems to be some relation between these option implied betas and the simple OLS betas. And in some sense, we argue that ours look less noisy.
And also from Sholes-Williams, remember the bias goes different directions between the most frequently traded, they're biased higher, the other are biased downward. And you have, out of the S&P, the most frequently traded the biggest stocks.
Yeah.
So according to Sholes-Williams, you have a directional bias with the OLS.
Yeah, I actually, you know what, we didn't think about doing that here at all because I figured, look, these stocks are so large that the asynchronicity is not going to be huge in daily.
It comes into the index because some of the index ones are small. Because you have the biggest ones.
Oh, so the index is too sluggish.
And so you have some of the small ones.
Yeah, that's a good point. I mean, I guess we could get around that by regressing on the futures maybe, but...
Or if you were doing things on the Dow, for example, these are made up of Dow stocks.
Yeah. So yeah, we could do that correction. We should do that. That's a good suggestion. Thank you. I think I'm out of time, and this is the conclusion. So remember, you can take away from this. If all you take away from this is the PCA analysis, I'm actually quite happy. When we do PCA on equity implied volatilities, we find very strong factor structure in level of IV, moneyness slope, and maturity slope of equity IVs. We develop a model that you may like or dislike. It certainly has some of the features that we find in the model-free analysis in the beginning. And I didn't really talk about the fit, but just showing you the pictures of the SMILE, the model fits reasonably well, ironically not so well for the index, but actually quite well for the firms. And we find when we look at the betas that we get out of the option implied estimation, that they relate to the IB level moneyness and maturity in the way that that the data suggests it should. That's it. If you have any more questions, I'm happy. But thank you very much for participating through my talk, and it was a pleasure to be here. Thank you.